Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, October 19th, 2018. Before I jump into the charts and commentary, I would like to begin with the quote of the week, and this week's quote is from Winston Churchill, who once said, "We make a living by what we get, but we make a life by what we give." Those are some very wise words from Winston Churchill. Well, the drama continues after last week's nosedive off the cliff, I guess you could say. The Dow, S&P, and NASDAQ staged a rip-roaring rally this week on Tuesday when the Dow jumped about 500 points. All the major indexes were up over 2%, and that was quite a day to see. But it was very short-lived, and that was pretty much given all away on Wednesday and Thursday. We had about a 95-point down day in the Dow on Wednesday and over 300 points on Thursday. So we head into Friday with 2 down days under our belt here in a row. And Friday is options expiration day when billions of dollars worth of financial products expire. So we'll probably have some volatility, and we'll probably have a significant amount of volume of trading put into the major stock market exchanges. So we'll see where we finish this week up. But right now, the word of the week remains to be caution. A lot of weakness on most of the industry sectors and most of the indexes, both in the short term and intermediate term. And I'm going to start off this chart review by showing you the Homebuilders Index, which is down over 20% from its highs earlier this year. It doesn't say many good things about the housing market, and that may be a barometer, or you could say a potential weather forecast for the housing market if you look at the home builders. It resonates with me a little because it kind of reminds me of 2007 and 2008. And not only are the home builders getting hurt, but you should take a look at overseas. And I'll give you a few bonus charts of some of those international indexes. So let's take a look, beginning with the home builders and then the Dow Jones. Here we go. Looking at this chart of the Standard & Poor's Home Builders Industry Index from November 1st, 2017 until October 18th, 2018. You can see that the home builders in the United States are not looking very pretty. In fact, from the highs of January 22nd to October 18th, this particular index has declined 27.7%. That is not a very good sign of strength for U.S. home builders. So this could be an economic barometer that may tell us what is ahead for our U.S. housing market. We'll just have to wait and see, but it is definitely a cautionary tale to pay attention to. Use the home builders and retail as a good indicator of the economic health of the United States. Let's take a look at retail while we're talking about it. In this chart of the Standard & Poor's Retail Industry Index from November 1st, 2017 until today, October 18th, we have from the highs of August 23rd of this year to where we are now, this particular retail index has declined by 11.3%. So we definitely have a sell-off in retail stocks that may indicate weakness in the economy going forward. This combined with the home builders, again, may signal some issues coming in the months and year ahead. So this is a good reason to be somewhat cautious and just pay attention to what this market is doing because these sell-offs are getting pretty vicious. And let's take a look at what happened over the last 2 weeks with the Dow, S&P, and NASDAQ. Here is that chart of the Dow Jones Industrial Average from November 1st of last year. You can see that we definitely came off pretty fast and furious from the high of October 3rd of this year. And we bottomed out on October 11th had a bounce, and then here's that big rally that I told you about on October 16th, and then the 17th and 18th we sold off again. So we'll just have to wait and see where we're going. But here is the issue. The indicators are starting to turn into bearish indicators. We have the 5-day moving average and the 20-day moving average, which are the short-term indicators. And you can see the 5-day moving average in red is well below the 20-day moving average in blue. And the 20-day moving average has peaked and is turning down. So those are a sign of increasing weakness in the Dow Jones Industrial Average. Let's take a look at the intermediate term. The 20-day moving average in blue and the 50-day moving average in purple. We still have a strength confirmation there for the moment. So it's still hanging on, but those two lines are converging, and we'll just have to wait and see if we get a crossover in the next couple weeks on the Dow Jones Industrial Average. Here is a chart of the S&P 500 going back to November 1st of last year. As you can see, the decline from October 3rd until October 11th was pretty fast and furious, followed by a bounce, and then 2 days of sell-off on the 17th and 18th here. So we need to be cautious and see if this particular sell-off has ended, or if in fact we are headed back down to test the lows of February, and see February 8th and the low of April 2nd. So let's watch how the next couple weeks play out. Right now, the 5-day moving average in red is below the 20-day moving average in blue, indicating short-term weakness, meaning days of weakness in the short term, whereas intermediate term is days to weeks. So let's take a look at intermediate term. The 20-day moving average in blue has now crossed below the purple 50-day moving average as of October 16th. So we have a lot of weakness going here with the S&P 500, so that is a very important reason to remain cautious. The other last remaining level of support for this S&P is not really the last remaining level of support, but an important support level is the 200-day moving average, which I have noted here in green. And if I change this to a candlestick chart, you can see that we came down on February 9th, touched the 200-day moving average and bounced off of it. We came down and tested it again on April 2nd, April 3rd, and April 4th, and April 6th, and then bounced off it again. Came down April 25th, as well as May 3rd and May 4th. Bounced off it again, rallied for several months, and then we came down and broke it on October 11th, bounced off of it. But as of the close of October 18th, which is Thursday, we closed right on the 200-day moving average. So it's holding for the moment. But if that 200-day moving average breaks with conviction and we stay down there for a while, that is not a very good sign for the overall market and the S&P 500. So remain cautious, and let's take a look at the NASDAQ 100. Looking at this chart of the NASDAQ 100 stock index, you can see that we also sold off pretty quickly from October 3rd into October 11th, and we came down and hit both of these highs, the high of January 26th and the high of March 12th, and bounced off it and above both of those prior highs. And then we sold off again on the 17th and 18th of October. So right now we closed on the 18th back below this high of March. So what we need to pay attention to is whether or not the NASDAQ continues to fall and comes on down and tests these lows of February 8th. That would be quite a drop. That would be very uncomfortable for most investors. So right now, let's take a look at those indicators. The 5-day moving average in red is below the 20-day moving average in blue, indicating short-term weakness. And the 20-day moving average in blue is below the 50-day moving average, which indicates intermediate term weakness as well. So much caution is needed with the NASDAQ 100 because the strength has deteriorated significantly, and if the index continues to fall back below the high of January 26th, that is not a very good sign at all for the NASDAQ 100, which led most of the stock market for the spring and summer of 2018. So let's pay attention to this, watch where it goes, and there's one other trend line that is important to note, and if it breaks, that will also not be very good for the stock market. If I go back and draw, this is a chart from January 1st, 2016 till today. Draw a trend line here and change this chart to a candlestick chart. Draw in that line. You can see that this particular index began, this trend line began June 24th, 2016. We touched it here, here, and here, and here, and here. So we got basically 5 or 7 touches, depending on how you want to look at it, or we can adjust it a little bit more. But we broke it briefly on October 11th and then bounced off that trend line. If this trend line, this red trend line breaks, which goes all the way back almost 2.5 years, and the price of the NASDAQ 100 breaks below that red line, then that is extremely bearish for the NASDAQ. So I'll be keeping a very close eye on that, and I'll let you know if there's anything that becomes of that trend line in the days and weeks ahead. Along the same lines as the emerging markets, we have the Shanghai Composite Stock Index, and I simply wanted to point out that in addition to the generic emerging markets index, the specific country of China is having significant issues. And from January 29th until October 18th, this particular index has fallen by 31%. So China is having some serious problems, and that is not going to go unnoticed because China is the second largest economy in the world, and for this particular index to fall 31% in 10 months has got to have some sort of repercussions for the rest of the world if it isn't already. So let's keep an eye on the Shanghai Composite, and before I wrap up the video, let's take one look at the German Dax Index to kind of get a sense of what Europe is doing. Looking at this chart of the German DAX stock index, you can see that it too is having some serious issues. From its high, which was made right here on January 23rd of 2018 until today, October 18th, the German DAX has fallen by 14.8%. So Germany is also having issues. And in fact, back here on, what day was it? Looks like October 10th, the German DAX broke below this low, which was made on March 26th, which is very bearish for the German stock index. Once we broke it, we bounced up again, touched, made a peak here. Once we came back up, we tried to test and get back above that March 26th low, but we failed. And on the 17th and 18th of October, we sold off again. So right now, we have the German stock index in decline as well. So to sum it all up, there is tremendous weakness across many of the countries, sectors like retail and home builders, and most recently the Dow, S&P, and NASDAQ. So use caution through the remainder of October, and stay tuned and keep an eye on these videos for updates as needed. Thank you again for watching this market update. Before you go, please do me a favor and click the subscribe button on this YouTube channel. And in the summary description of the video, as well as in the top right-hand corner of christensenwealth.com, you will find links to the Facebook, LinkedIn, and Twitter pages for Christensen Wealth Management. Please visit those social media pages when you have time and like or follow them while you are there. That way I can communicate with you throughout the week through these videos and through social media. Well, have a great day, and I look forward to seeing you again in about another 7 days. Until then, remember to be cautious, be vigilant, pay attention to your money, pay attention to the markets, and as my friend likes to say, getting back to even is not an investment strategy. So focus on preserving your wealth in these uncertain times. Have a great day. Bye-bye.